Good evening, everyone. Welcome to our California first-time homebuyer workshop. My name is Jason Maida. I'm with American Pacific Mortgage. Excited to bring to you this content this evening. This is a session that we put on throughout the year to help educate our communities in home ownership. If you like what you hear this evening, love for you to be able to share this with your friends, family, some of your coworkers. We hope to, pass on some great tools and resources to help you on that journey towards home ownership. Obviously, we're in the spring buying season, a lot going on in our local housing market. So my goal is to kind of share with you what's happening from a lending perspective. Again, my name is Jason, and I work with an organization called American Pacific Mortgage, and an educator in home ownership and the leading provider of first-time buyer programs in the state. So I'm really passionate about providing home buyers affordable resources and tools that they can help themselves achieve home ownership. And so I teach classes like this in our local communities in California just to help educate up our future buyers in those local markets. Today, we're going to talk a little bit about what's going on in the housing market, share with you a little bit about interest rates and some of the activity levels that we've seen and what's kind of driving interest rates. We also want to spend some time looking at, does buying make sense for me? And I'm going to walk you through a rent versus buying calculator so you can better understand when you compare renting versus owning, what it could look like for you as a prospective buyer. Now, credit plays a role in homeownership as well. So we want to spend some time giving you some answers and some tricks and tips around credit building and understanding credit. We'll outline some loan programs for you. We'll look at savings for homeownership. We'll set some savings goals as well as some of the resources you can pull in to help you meet your down payment objectives in homeownership, as well as first-time buyer programs that can close the gap in really what you need out of pocket to buy a house, as well as the buying process. And that's in the latter stages of tonight's class, but really the workflow of buying a house and really how do I go from a class like this or just making an inquiry online to how do I take the steps towards home ownership? And I will share with you this evening what our free consultation looks like. It'll help really guide you in home ownership and design your plan to achieve that goal. All right, so that's our plan for tonight. Really excited that our class could join us. And we will be recording tonight's class. And those of you that have signed up for tonight's class, we'll share back all this presentation material with you so you can refer to it in your notes as you kind of decide on taking those next steps for home ownership. Well, as you're thinking about taking those next steps, this is a big financial decision. It's probably the biggest decision you're going to decide to make. And I think there's a lot of thought that, that goes into this because this isn't like making a smaller purchase like a car, for example. This is a big deal, and it's going to take some time and some patience and some resources to make that dream come true. When we can achieve home ownership, I think there's really some key things to think about with home ownership. One is affordability, and that's a challenge for many of us in all the markets that we work with and clients is, it's an expensive market. But when you're a homeowner, you do have the opportunity to kind of control your budget. Whereas if you're a renter, you're really relying upon what the landlord's going to charge you in your next lease that you renew. And those are our clients that are going to decide to purchase in today's market. There will be opportunities for them to refinance at some point in time. Even though we're at elevated levels of interest rates today, there will be opportunities to refinance down the road. When we think about buying a home, this is an asset, and it's an asset that can mature and really gain equity over time. That opportunity of equity growth can really be transformational for us as homeowners. It really even has the opportunity to create generational wealth for families through the growth of equity in our home. Now, what is home equity? Well, home equity is the difference of what my market value is in my home versus what I owe in my home. So if I have a house that's worth $500,000 and I pay down my mortgage to $400,000, I have $100,000 in home equity. And what are the really key benefits of home ownership that many clients can tend to forget about is tax benefits that come along with owning a home, potential tax deductibility of interest on my mortgage. And if I decide to make energy efficient upgrades on my home, that could also improve my tax position as well. We would always encourage you talk to a tax advisor, but those are things that I would really encourage clients to think about when it comes to considering home ownership. Now, as we're figuring out what that could look like for us, one of our calculators that I always share in our classes can be really helpful for you in kind of figuring out your entry into home ownership. And it's called a rent versus buying calculator. And it's one of the many calculators you can find on our website. what a rent versus buying calculator does is it positions yourself to understand financially, what does it look like for me to continue renting today versus what could it look like if I decide to purchase a home at some point, and it gives you a break-even point. So I've pre-filled out one of our calculators for tonight's class to keep us on track with our session, but I thought I would walk our class through this exercise as an example. And I would encourage you after tonight's class, you're going to get the presentation material so you can walk through this calculator yourself and run through some different scenarios to see what homeownership could look like for you. Well, if we dive into this calculator, we'll first start with home price. And in this scenario you see on screen, we have someone that's considering a purchase price of $600,000 with a down payment of 3%. And you're going to learn more about that in our program segment, where the minimum down payment for a first-time buyer is 3%, which means I would finance 97% of that purchase price, or $582,000. Would put an interest rate today in the market of about 6.5% on a 30-year fixed mortgage. And then let's assume that we're going to buy that house. We'll put our calculator out here to sometime, and we'll push down into 2020, the latter part of 2026. So we'll say December of 26. Okay, that'll be our start date of our home purchase. Now, when we purchase a home and we put less than 20% down, there is mortgage insurance. And mortgage insurance is based upon credit score, down payment, and then how much I decide to finance. There's also homeowners insurance that's involved with the home purchase, the tax rate that I'm paying, and maybe I'm considering a condominium or a townhouse. Then we want to factor in HOA dues into our budget. And then we talked a little bit about tax benefits of owning a home. So some of the assumptions we make in this calculator is what's my tax bracket, which will obviously drive what I'm paying in federal taxes, but the potential tax benefits with ownership. And then how much is it going to cost to maintain my house, potentially sell down the road, and appreciation, depending on what part of the country, obviously California, but part of California we're buying, some areas of California appreciate higher or at higher paces than other parts of the state. We have monthly rent that we want to plug in, as well as the expenses of being a renter, like renter's insurance. And then, if our landlord if they do decide to increase the rent, what could that do to us from a monthly payment perspective? So what our calculator tells us then is that what's going to be the break-even point for me in home ownership versus renting. So if I was to compare renting and buying, and I timeline them exactly at 3 years, 3 years of rent, 3 years of mortgage, I'm going to break even in home ownership after 3 years. Then beyond the 3 years, I'm kind of on the positive side, right? I'm now in the plus of ownership. And that is a really great break-even point. I generally would want our buyers to be at 4 years or less. Now, if we look a little further, and let's say we start to span out over 5 years, well, after 5 years, now we have about a $44,000 buying opportunity versus, continuing to rent. You can just see the comparison here. After 5 years, I've spent $189,000 in rent compared to buying when I factor in tax benefits, equity appreciation. Now I've only spent $145,000. So that's how we get the plus side of $44,000. So that really is kind of the magic in home ownership that I think gets a little bit lost in kind of translation when we're thinking about making that plunge into the market and purchasing a home. And I think that rent versus buying calculator can really help to reframe everything for you as prospective buyers. Now, when we make that entry into the housing market, what prices of homes are looking like and what communities I want to buy in, whether that's the peninsula of the Bay Area, whether that's in the Sacramento Valley, the San Joaquin or Central Valley, LA, Orange County, San Diego, whatever market you're considering, the entry point of price is going to obviously play a big role in when we make that move. Well, no surprise to anyone probably joining tonight's class is we're seeing an increase in prices in most California markets. This is the median price in California at $770,000, up 0.7% year over year. Now, I will, to be transparent with our audience here, we do see markets that are on the decline, some that are a bit overinflated, but when we look collectively across California, we see a little bit of an uptick in market. One of the big positives we are seeing more inventory enter the market, more resellers that are saying, hey, you know what? Yes, I'm at a 3.5% rate on my current mortgage, but I really need more square footage. I really need to get my family to that school district. So now they're willing to kind of make some compromise and sell. So that's an encouraging sign because over the last 3 years, we really haven't had the inventory to help support buyers. So that's good news there. And then we're seeing an uptick in how long homes are staying on the market. So sellers are starting to have to reconsider what their asking price is for a home. We're seeing a lot of price cuts. Right now, we have about 40% of all transactions that our office is handling that have some type of seller concession on them, meaning the seller has reduced price or provided a credit to the buyer because of negotiations. So that's also encouraging for buyers. What is 2026 going to look like for us as we consider the forecast in the housing market? Well, nationally, we're going to see the market in a bit of a reset, where 2026 is going to hopefully be a little bit more affordable for most buyers entering the market. Of course, we didn't expect the conflict in the Middle East to arise, and so that has kind of changed our perspective a little bit on rates. We're seeing a slight increase in rates. But as of late, we've seen, especially over the last 4 or 5 trading days, we've seen rates start to decline. We did tip out at about 6.75 in rates earlier this week. Today, we're right around 6.5%, so that's encouraging. Hopefully, we will see some resolution in the Middle East soon. That will help not only oil prices, but probably bring a little bit of calm to the interest rate market as well. Price growth is expected to be modest in most markets. We're not going to see really any big jumps in appreciation. Hopefully just a little bit of stabilization in most markets, but we could see some price correction in certain areas that are more oversupplied in some markets. With supply, we are seeing local builders trying to build more homes to help support, what we need from a buying perspective. But we still need more inventory to help support our buyers, especially if interest rates go even lower. Then we're going to need more supply to support the demand of buyers in the market. Really, when in a market like today that we see, some of the challenge that we face in interest rates or lack of supply can really present some phenomenal opportunities for buyers. And when we teach classes like this throughout the state and across the country, we hope to, provide some encouragement to our clients or future clients that they can enter the market, and it's not an insurmountable task to entry to homeownership. This is another forecast for the California housing market and just gives you kind of a little bit more of a historical look at things. You can see our resale price going up. You can see that percentage of change up 2% in the forecast for 2026, median price going up with a 3.6% forecasted change, and affordability improving slightly just because the forecasting of interest rates. That number still remains to be seen. We'll have to see how that kind of plays out. Now, what's happening with interest rates? There isn't a day that goes by that I don't get a question about interest rates. This is a historical look at the last 3 years of interest rates. And I kind of commented earlier that what we saw, interest rates ticking up a little bit in the preceding 5 days, but we've seen a little bit of relief. There is some hope that there will be some resolution in the conflict in the Middle East. So that's kind of brought the markets down a little bit. This market remains very volatile, and it's probably not going to change anytime soon. Some of our early projections for interest rates and where they were going have changed quite a bit, which is the dynamic of kind of what's going on globally right now. But we will obviously be monitoring interest rates really carefully for our clients to really try to seize the moment when an opportunity arises for them. Now, interest rates change by the minute during the trading day. So the trading day opens up at 6 a.m. Pacific time, and it closes at 2 p.m. Pacific time. So within that time constraint, interest rates can move all over the board. This morning, interest rates didn't really have much improvement when we started the trading day. They finished up in a better position by the end of 2 o'clock Pacific time. So they change daily throughout the day. And then when we elect a product, there's an interest rate that's attached to that. So when we look at interest rates, it's not the same for all clients. Things like credit score and eligibility can influence the interest rate, the program, how much I'm going to finance, what my down payment looks like. There is a thing called buying points or discount points to help bring down the interest rate. Usually 1% of your loan amount equates to about a 0.25% reduction in rate. In today's market, even though we're at elevated levels, not necessarily something I would recommend to clients because it's about a 4-year break-even point when we look to buy points on loans. And then loan terms can also change what my interest rate looks like. The shorter my term of my loan, probably the more improved interest rate I'm going to have. All right, now we're going to talk a little bit about credit, and credit is one of those characteristics that go into the makeup of interest rate selection. Every loan program has a minimum credit score. You can see those showcased on our slide here. So we have those minimum credit scores. We do look at a mortgage credit score when we evaluate clients' options for home buying. Now, there's 3 different models to credit scoring. There's the credit card model, which will show up in most of your monitoring services. There's the auto financing model if you're going to go buy a car, and then of course the mortgage financing models. And there's also 3 different agencies that report out, right? There's Equifax, there's TransUnion, and there's Experian. Each one of them have their own models. Each of them will give a different reporting. So if you looked at your Credit Karma score before tonight's class and it was a 720, if we go to pull your mortgage score, it might be 730, it might be 710. And the reason for that is because there's different factors that go into a mortgage score versus that credit card score. Now, if you've had some past challenges on your credit report, like a late payment, over limit on your card, they're going to really impact your score in the most recent 12 to 24 months. That's where we're going to really see the impact in score. And so we really want to pay close attention to those items. I'm going to talk to you about the modeling for credit and what it looks like and what's going to impact you the most. But really, in the most recent 12 to 24 months is going to be really important. Now, with those 3 agency scores that pop up to us, we take the middle score of all 3 agencies reporting. So if my top score is 760, my middle score is 740, and my lowest score is 720, we're going to take the 740 credit score when it comes to evaluating our options for product, interest rate, even the cost of mortgage insurance. Now, if my partner is going to join the financing and let's say they have a 720 middle score, well, that 720 will supersede the 740 credit score. So that's what we would use for qualifying purposes. So we always take the lowest middle credit score of both clients that are applying on the financing. This is a matrix that will help you better understand how long negative items will remain on your credit report. To my earlier point, the impact to your score will be in the most recent 12 to 24 months, but this shows you how long they will appear on your credit report. On the mortgage model for credit scoring, this is the weighting of the score calculation. I want to walk you through each one of these areas so you can better understand. And my hope is that our class would kind of identify an area of opportunity in their own personal credit score to help improve things. Because we do want to create affordable homeownership for our clients, and the ability to be able to do that oftentimes centers around improved credit scoring. In fact, that's one of the conversations I just had before this session today with one of our clients that's in the process currently today, is like, how do we maximize credit score? Well, if we look at one of the weightings in score, which is length of credit, how long have I had my credit score is 15% of the weighting for the credit scoring. So the more mature my credit file is, the higher my credit score is probably going to be. 20% is going to be how much new credit am I trying to get access to. I really want to limit any new inquiries on my credit report, new account openings, especially in the most recent 6 to 12 months. And then the amount that I owe on my credit cards, my revolving debt, can really impact my credit score. It's called credit utilization. Ideally, I want those credit balances to be at 10% or less of my outstanding credit limits. If I'm running a little bit higher in outstanding credit balances, let's say I have an aggregate total of $10,000 in credit limits that I have access to, but I have $6,000 in balances, I'm currently at 60% utilization of credit. Our coaching for our clients would be to let's try to move that down to a $5,000 balance as step 1. Once we've gotten there, let's get to a $3,000 balance. And then ideally, let's get to $1,000 or less in credit utilization of debts. Now, one way of managing your credit card debts is to try to pay those balances off or down before the end of what we call the billing statement date. It's different than the due date on your loan. It usually closes out the preceding 30 days of credit activity. So my tip for our class tonight would be try to pay those down before that billing date closes out, because when that date closes, that means the credit card or creditor has sent out all your account information out to the 3 agencies. And so we want to try to get ahead of that reporting. Last thing is payment history. How have I paid my bills? If I've had any late payments, they're rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. Again, we're looking at the most recent 12 to 24 months of history on those accounts. Now, one of the accounts that can show up on our reports is student loans, and how student loans can affect us, not just only from the on-time payment history, but the payments that we have to count in the qualifying for your home financing. Now, many of you that are attending tonight's class may have student loans that are in deferment, maybe forbearance. If you're looking to apply for home financing, if they're in one of those statuses, we have to count a minimum payment for qualifying. So if you are in a deferment or a forbearance, we count 1% of the aggregate balances for the student loans. On a conventional loan for Fannie Mae, it's 0.5% for an FHA loan. If you're in an active repayment right now, it's a savings plan with, say, $75,000 in debt, and we're at a $250 payment, That 250 payment is what we'll use from a qualifying perspective. I share these calculations with you to hopefully give you some encouragement around homeownership, because oftentimes as I'm working with clients across the state and the country, people feel like that's going to be a major hurdle for them, is the activity of student loans. And so if we can kind of help you understand the calculations, when we meet with you for a free consultation, we can kind of figure out where those student loans come into play with your home buying plan. All right, now the reason why we do take a look at student loans is because all loan programs that are offered by lenders like American Pacific Mortgage have guidelines that address how we view those student loans. And so I want to take some time now during our product segment to talk a little bit about loan programs. And you've probably heard some of this terminology. So for many of you in tonight's class, this might be a bit redundant, but I do want to share with you from a high level look what some of these loan programs look like. So the first one is a conventional loan, and a conventional loan is centered around Fannie Mae and Freddie Mac with a minimum down payment of 3% for first-time buyers and a minimum credit score generally around 620. Now, there is what we call as a conforming loan limit set annually, which today is at $832,750. If you do go beyond that loan amount, then this becomes now a high balance loan. And in some markets, like for example, LA County, you can go up to the number that you see on screen of $1,249,000, but the minimum down payment then jumps from 3% to 5%. Okay, but in a conventional loan, typically we go up to $832,750 with a minimum down payment of 3%. And we're going to talk more about first-time buyer programs in just a bit and share with you kind of what that looks like. Now, the next product is an FHA loan. That is a government insured loan. It does have a minimum down payment of 3.5% with the minimum credit score you can see on screen. And then that maximum loan amount will vary based upon the county that I'm going to purchase in. Both the FHA loan and the USDA loan are both government insured loans. Now, both of these also do have residency requirements. So you do have to be a permanent resident, unfortunately, with these products. Whereas on the conventional product that we just reviewed, you can be a non-permanent resident and still participate in that financing resource. USDA, the benefit around that product has a 0 down payment option, 620 minimum credit score. It's more designed to purchase in rural areas. So you can purchase in a market like, let's say Sonora, for example, if you're in Northern California, you can purchase in that market with a 0 down payment option. But you do have the qualifier of the location. Plus, we also look at your total household income. And then the next product, which just isn't utilized much for first-time buyers because it's going to be at the higher price points and higher loan limits, is called a jumbo loan. And a jumbo loan is going to have a 10 to 15% down payment requirement, but also higher credit score requirements. It's really designed for clients that need financing that's going to stretch beyond like the conventional loan limits. Now, not on screen, that we do offer as well as a physician's program, which a physician's program will give a little bit of relief to qualifying with student loan documentation, a little bit lesser down payment requirements. So if you're interested in some of the resources in the physician loan space, just let me know offline and we'll certainly have those conversations and see if that kind of helps support you in your home buying goals. The last product is for our veterans that have eligibility on the VA home loan product. It's a 0 down payment option, minimum credit score of 620, really no maximum loan amount. And it's reserved for veterans that have the VA eligibility. A lot more flexibility to provide that entry to home ownership for the veteran. So just a fantastic product to help the veteran with a 0 down payment option. Now, as we talk more about the details of financing, the conversation around mortgage insurance always comes up with our clients. And I want to explain to you now what mortgage insurance is all about, or PMI. PMI stands for private mortgage insurance. And then on an FHA loan, we have MIP, or mortgage insurance premium. They both function the same from the perspective that they insure the lender against default by the buyer. So if I had an economic hardship and I was unable to make my payments, the insurance would protect the lender against default by the buyer. But these mortgage insurance attributes look a little bit different. On a conventional loan, the mortgage insurance is based upon down payment, credit score, and then how much I finance. PMI on a conventional loan does also have a cancellation option that you can see on screen. And then the mortgage insurance is a little bit cheaper on a conventional loan as opposed to an FHA loan. Ideally, we want to target a conventional loan for our buyers, but sometimes we have to look at the FHA product just from a qualifying perspective. If you've started some of your home search already and you're doing some payment calculators on Redfin or Zillow, you'll find the mortgage insurance can be a bit elevated just because it's not calibrated to some of the characteristics I'm sharing with you in tonight's class. So I would encourage you to take a look at some of our calculators. They seem to be a little bit more accurate in the details that you get. On the FHA side, there's actually two forms of mortgage insurance. There's MIP for monthly mortgage insurance, and there's also upfront mortgage insurance. So mortgage insurance on FHA can tend to be a little bit more expensive, but it does give the buyers more flexibility in qualifying with lower credit scores. It does not have a cancellation option for refinancing. Oftentimes, clients will point out the lower rate options for FHA to me. They'll say, "Hey, Jason, I noticed FHA rates are 6%, where a conventional rate is at 6.5%." And you're absolutely right. They are going to have lower rates on FHA loans. However, on an FHA loan, you don't realize the cost of expenses in a mortgage insurance component for FHA when you compare that to the conventional product. So we can see that displayed here, $12,000 in upfront mortgage insurance, where the conventional loan doesn't have that. And of course, the monthly mortgage insurance is a bit more expensive. So that's something we'll obviously have conversations with as we design your home buying plan. But I always like to kind of point that out, the differences as we look at mortgage insurance on conventional and FHA. Well, we also want to talk a little bit about qualifying income for purchasing a home. I'm going to share with you some of the documentation needed as you start these next steps in homeownership and getting a chance to hopefully meet with me for your consultation. This is generally some of the documents that we'll request. And then I always like to share back some scenarios that we encounter and maybe dispel some myths for you around employment or income used in homeownership. Now, we always have to verify a 2-year work and/or educational history. So you don't necessarily have to be on the job for 2 years to be eligible for financing. We just have to put together a 2-year work and/or education history. I may have just started my job with the state of California on January 1 and say I graduated from Sacramento State in the fall. Even though I've been on the job less than 6 months, I can still apply for financing because I can show my Sac State history as well as my new employment with the state. So we just have to put together that 2-year work history. Now, on the other hand, if I'm in a variable compensation role, I have a base salary, but I want to count my commissions, maybe my overtime or my bonuses towards my home buying plan and my qualifying income. In that case, I have to show that I've been on the job simultaneously for 2 years in order to count that variable income. Because what an underwriter does is they look and they assess your historical averages in your income that are coming from variable sources. Base salary, obviously pretty easy, but variable sources, they have to do kind of a 2-year average. If I'm self-employed, I do take a 2-year average of the net income for the self-employed individual by looking at their 2 years of tax returns and their trend in their income through their current profit and loss statement. Now, if I have dual employment, maybe I work for 2 different health clinics. If I do want to count both sources, I then have to show that I've been on both jobs simultaneously for the last 2 years. Last thing I just want to point out to our audience is that if you maybe drive for Uber or DoorDash on the side, but want to count that income along with your full-time job, if I do want to count both sources, I do have to show that I've been on both jobs simultaneously for the last 2 years, okay? So those are some of the scenarios that come up for us as I get a chance to meet with clients. And as we consult with clients, we also compare expenses versus income in our home buying plans. And we call that calculation debt to income ratio. And it compares your current or existing expenses along with your new projected housing expense versus your pre-tax income that you have verified, that we have verified for you in your home buying plan. So my home ownership budget looks at my principal, my interest, my property taxes, my homeowner's insurance, maybe mortgage insurance. Maybe I'm buying a condominium or townhouse, so that all goes into my home buying budget. And then I take into consideration credit cards, personal loans, auto loans, whatever that might be, versus that pre-tax income. And you can kind of see an example we put on screen here for you. So if I have $3,000 in the expense line and I'm making $8,500 a month, that debt to income ratio calculation tells us that $3,000 in expenses a month will consume 35.3% of my pre-tax income. Now, I get asked often, well, Jason, what should that number be? Well, the guidelines allow us to go to 45, even 50% of that number. But I would say from an affordability or sweet spot, comfort zone, whatever you want to call it, generally is when that number is about 33 to 36%. That's when clients feel like that's pretty affordable for me. There's 2 big goals for us around home ownership. It's affordability, which you've heard me talk about a few times tonight, but it's also sustainability. We want you to be able to purchase your home with peace and comfort, knowing that you're going to be able to take on that monthly payment without any challenges as you kind of go through that journey of being a homeowner. All right. So that's what debt to income ratio looks like. We'll talk you through that too during our consultative process. We're also going to talk about savings for homeownership and assets that are needed to purchase a home. There's two things we have to save up for in homeownership. It's down payment, but it's also closing costs. And so there's acceptable sources of down payment and closing cost documentation. Of course, we can use checking and savings accounts. Retirement accounts can be used. We don't count 401k loan payments against you in qualifying. But I would always encourage you, if you're talking about using investment accounts like 401ks or brokerage accounts, talk to your tax advisor or your financial advisor. Just make sure that's the right path for you in savings for homeownership or accessing savings for homeownership. Gift funds can also be used in homeownership too. Family members can contribute. All assets can be all assets used in a home purchasing plan have to be seasoned for 60 days, but gift funds do not. So if you have a grandmother or parent that wants to contribute towards your home purchase, they can transfer that money right away. It can't be cash. It has to come from a viable institution, but they can do that, and that can be used right away in your home buying plan. Now, to be honest with our class here, that savings for homeownership in today's market is probably one of the biggest challenges for homeownership. And so what I always like to do in class is to teach a savings plan. It's a very simple approach to savings, and it's outlined over here in this box. And I want to kind of describe that to you. So if I have a scenario today where I'm paying $2,000 a month in rent, and after meeting with me for your home buying plan, we've kind of calculated your new mortgage payment to be about $3,500 a month. And you say, hey, yeah, that feels pretty good. I can do that, but I only have $5,000 in my savings account. And maybe that's making homeownership a little bit out of reach. So what I would encourage our client to do is let's start saving like I'm making that $3,500 mortgage payment today. So on the first of the month, I pay my $2,000 to my landlord, but I create that habit that I'm going to take an additional $1,500 that's allocated for my savings and put that right into that account on a monthly basis. And it's like paying that $3,500 mortgage payment. So I'm doing two things. One is I'm saving obviously up for homeownership. And by the end of 6 months, I have $9,000 saved up. By the end of the year of $18,000. So I get that savings goal reached. But I'm also acclimating myself to that new mortgage payment of $3,500. So it doesn't feel like a big lift for me when I get settled into homeownership and I can make that payment without any strain to my household budget. So that's a really simple approach to homeownership and savings for homeownership. I've had lots of clients apply something like that. It's very simple math, but I think it's really super effective, and it creates that discipline for you in savings. Now, there's also assistance programs offered in the state of California to help really close the gap for you when it comes to what you need for homeownership. I'm very proud to be the #1 provider of the CalHFA assistance program in California. As an ambassador of this program, we teach these classes usually once to 4 times a quarter just to really spotlight the CalHFA assistance program. CalHFA has just hit the 50-year anniversary, providing support to low and moderate income households all across California. CalHFA stands for the California Housing Finance Agency, based in Sacramento. And you've probably heard about CalHFA through one of the new products that we just launched, which we have on screen here, the Dream for All program. That is a lottery-based program. Lottery recipients just received their vouchers last Wednesday. There's 3 different statuses to that program. You either get a lottery voucher that allows you to go out and start shopping for homes. You either get waitlisted for the program or not selected. So proud to be able to be one of the help create some of the ideas around that program, but also be able to administer the program in our local communities. So if you're interested in that product, love to be able to get connected with you. We don't know what future funding looks like for that program, but that's more kind of a stay tuned situation. Now, there's other programs that are accessible today that are not lottery based with CalHFA, like the My Home Assistance program, which provides up to 3% of your sales price in assistance on a conventional loan, 3.5% for an FHA loan. These are essentially low interest rate loans at 1% interest, simple interest, and they don't require any repayment until you either sell the home or if you refinance in the future. We can also layer on programs like My Access or the CalHFA Zip Assistance program to help support you with closing cost resources as well too. So a lot of great tools that are available to you as resources in your local community. And these programs have much higher income limits than some of our local community products. Now, within APM, we also offer a national program like Pathway DPA. That'll really help clients that maybe not qualify for CalHFA, whether it's because credit score or income limitations, but it works with an FHA loan. We have a 1% program that provides a 2% grant for clients that are below 80% median income in markets. And of course, the Golden State Finance and Chenoa Fund. Our primary product that we generally look for our clients, because it's the least expensive product, is the CalHFA Assistance Program. As an ambassador to that program, I just think it's just a much more supportive program for our clients and just gives us a lot more flexibility to design the right program for our clients. Here's what an example looks like using a program like that. If you purchased on a conventional loan with, say, a $700,000 purchase price with 3% down, with closing costs that we generally estimate 2 to 3% of your sales price, that would probably require you to have about $35,000 to $42,000 cash on hand. But when you implement a program like, say, the My Home Assistance Program, we can now layer in a $21,000 assistance option to help decrease that out of pocket tremendously. Maybe I need more help from the state. We can add in a program like My Access with an additional $16,000 in assistance and now have my eligible assistance somewhere over $37,000. So we want to provide encouragement for you in tonight's class that there are resources out there to help you reach those goals of homeownership. Maybe after tonight's class, you thought homeownership was a 3 or 5 year goal. Maybe it's now a 1 or 2 year goal, or maybe a 2-month goal for yourself. But ultimately, these can provide resources for you on that path towards homeownership. There are eligibility requirements within CalHFA. There's minimum credit scores by product. And the debt to income ratio that we talked about earlier goes up to 50%, just like the regular conventional and FHA guidelines. Now, the income qualification for these products are based upon applicant, not your household size, like many programs do. And it's only for first-time buyers, which a first-time buyer is someone that hasn't owned a home in the last 3 years and designed for one-unit properties. This is a kind of a spotlight of some of the income limits. It looks like we have just Southern California here. I think Ken, my colleague who's also on the session today, will put in the link to the CalHFA income limits in the chat if you want to check those out, because we have probably a lot of you that are attending from Northern California and some of the Bay Area markets, so you can check that out. You can find all of the income limits on the CalHFA website as well. The last thing I do want to point out to you on the CalHFA product, the rates for these programs are all set by CalHFA daily at 8 a.m. So as the leading provider of these programs, we have one of the most affordable cost structures with these programs, but the interest rates are all the same for all lenders that have the opportunity to offer the product. Ken just put the link to the income limits in the chat. So if you want to check that out, you can go ahead and see the page for the income limits. All right, well, we're winding up tonight's class. Before we adjourn tonight's class, I do want to share with you one of probably the most important things in the buying process is the workflow of owning a home. After tonight's class, hopefully I get a chance to connect with you for your free consultation and design homeownership. I spend most of my day consulting with clients for 30 minutes virtual sessions to help design home buying options. So if I'm not teaching a class like this, I'm generally helping provide solutions around homeownership. So I'd love to be able to connect with you for a free consultation. What does a consultation mean? Well, we're designing a plan for homeownership. Many of the topics that you heard tonight are going to be part of that session that we put together for you. The output of that meeting will be to have you pre-approved. Whether you want to buy this summer, whether you want to buy in 2027, you'll at least have a plan around homeownership. A pre-approval is generally good for 60 days, but I can always recertify it for you at any time. So I never want clients to feel rushed in this major financial decision. So whether it's going to be this year or next year, let's just provide you the baseline for you of homeownership. Now, when you're ready to start looking for homes, it's probably going to start online, eventually transition to in-person. I always encourage clients across the markets is to talk to a trusted realtor. We have a fantastic preferred realtor network. So if you want me to connect you with one of our trusted resources, love to be able to do that. So you'll start that house hunting phase. And one of the questions I get asked often is, Jason, how long is it going to take me to buy a house? Well, probably centered more around this part of the process, which is depending on how long it's going to take you to find a home. Some clients find a home in 2 or 3 weeks. Sometimes it takes 2 or 3 months. Sometimes it takes 2 or 3 years. Whatever that sales time takes for you, we're going to be here to help support you in that journey. Now, eventually you're going to find that home and a realtor will help orchestrate an offer for you to that home. Now, your offer might not get accepted on the first round. It might take 2 or 3 times. I've had clients that have 4 or 5 shots and not get the right home, but ultimately at some point a seller will accept your offer. Now, if that offer gets accepted, then you're going to move to step 3, which is called entering escrow. It means that a seller has accepted your offer. On the date your offer is accepted, you're going to get a call from me saying, hey, congratulations, you did it. Your offer is accepted. Now let's talk a little bit about next steps in the process. And I want to get you scheduled for a follow-up video session so we can meet for about 45 minutes to go through the design of your financing. Now, there will be some action items on your side, which is things like getting an earnest money deposit made, which is usually 1 to 2% of your purchase price. We'll get all the financing structured for you so you know exactly what you're paying, whether it's monthly payment, assistance resources that we're tapping into, out-of-pocket expense. We're going to go through all of that during your follow-up video session. This is what an earnest money deposit looks like. The assistance programs cannot fund the earnest money deposit, so it will be something you have to put out of pocket. That money will count towards your total expenses for your home purchase, those closing costs and down payment that we talked about. Now, the earnest money deposit is protected by what we call as a contingency period. A contingency allows you to do your investigative work on the home, but have your deposit protected. We're going to get the house appraised to make sure the house is worth what you're buying it for. Get your house inspected with your realtor. Will help organize that to make sure the house doesn't have any issues. And then, of course, we'll get your loan approved. Those contingency periods can be as short as 7 days. They can be as long as, say, 17 days. The total escrow process in most markets in California will be about 30 days. So to go from step 3 to step 6, it's about 30 days. But the needle has been getting shorter and shorter in some markets. Sometimes it's 21 days. Sometimes it can be as 14 days as the shortest time period. As we move through these milestones, step 4 is going to be more the administrative functions of your loan. We're going to verify your employment, verify your assets, making sure the financing is set up properly so we can submit to the underwriting team. We talked a little bit about interest rates earlier. Interest rates change by the minute. Once we're under contract with a home, we're going to have some strategic conversations about what interest rates are doing and help kind of provide some education for you on the timing of when to lock in your interest rates. One of the values that we provide to our clients that we work with is that I'm watching the markets at 6 a.m. till the markets close at 2 p.m. So we're trying to seize opportunities for our clients because interest rates could be 6.5 at the start of the day. They could be 6.3 at the end of the day, or maybe 6.7 by the end of the day. So it's really important to understand what's happening in the markets. Step 5 is going to be your loan approval. And that's probably about 2 to 3 weeks in the process. We'll have the loan approval, if not a shorter time period. It also means that we got the appraisal back, your loan's approved. You've now received disclosures in the process. You're going to get different iterations of disclosures. We will issue to you at step 5 a final closing disclosure that gives you a 3-day cooling off period in the process before we get to the very final stages, which is closing the loan. And the closing the loan is one of the in-person aspects of the process, let alone finding your home and going out and checking out the house. But at the closing of the loan that day, you're going to be signing final loan documents with the public notary. You will also be expected to wire in your final funds on that day. We'll also wire in the funds for the mortgage. The documents that you've signed now will have some recordable documents. The escrow team will record those documents with your local county that you're buying in. There's a transfer of ownership called the grant deed and then a deed for the loan. They'll get confirmation that everything's been recorded. We'll also get that confirmation, and then I'm going to get a chance to give you a call and say, hey, guess what? You did it. High five. You're now a new homeowner. Huge celebration. Tomorrow I'm super excited because we have 4 new homeowners that are going to get the keys to their house. So I'm like pretty fired up about tomorrow's call because I get a chance to congratulate everybody, and you get to see everybody's pictures of them getting their keys in front of their house. They're holding their sold signs. It's a huge deal, right? And many of our relationships with our clients start in safe learning environment like this, and then it progresses to consultation and going out and doing the home search, and then ultimately getting their keys to their house. So I hope you're on that journey as well. Our relationship with our clients don't end there, though. After the closing of escrow, we have our aftercare program to stay connected with you. Through our Rate Watch program, because let's face it, you'll have opportunities to refinance as a homeowner at some point. So we want to make sure that we're top of mind for that. The ability to be able to track your home equity through our HomeBot system, and then just getting an opportunity to check in with you on an annual basis just to see how you're doing and how we can best support you. This isn't a transaction for us. This is a long-term relationships. We've had clients that have been stretched over 15 years with us, and whether that's a call or text just to check in with someone, we always want to make sure that we're here as a resource for you. Now, if you're thinking about getting started in the path towards homeownership, you've heard me talk a little bit about our free consultation. It has a simple 3-step process. Starts with a simple online application. We do have to do a soft credit check that does not impact your score. You'll upload documents that are requested as part of the application, and then you'll use our easy link here to schedule your virtual session. And we'll meet in a virtual environment for just about 30 minutes, just to kind of better understand how we can build your plan for homeownership. Sorry, my slides are jumping around a little bit. This is what a consultation looks like for you. I will tell you, it's much different than what most lenders will do in terms of designing your home buying plan. We're really big on education as a leader in this space in the industry. And so we really want you to understand what's happening with homeownership. I meet with every client for that 30-minute session that we help in our market. And it's really important for me to help go through these really important items for you in your design of homeownership. Now, last thing I want to kind of point out for you is technology. We embrace technology, whether it be our mobile tools that you can start the process, whether it's some of our AI technology to help get you all the resources you need. We always want to make sure that we have technology available to you. But what's really important to us is it doesn't change the human element of the buying process. We're very connected with our clients. Let's face it, this is a big financial decision. I'll be responding to text messages that I got during tonight's class, or our calls or emails. We want to make sure that we're very connected with what's going on in your buying process. So, it's a big part of our relationship and partnering with you on this journey. Now, as part of this journey, we provide, discount products in our community. So, we want to make sure it's affordable homeownership. So you can learn a little bit more about our discounts on our website at mortgageeducate.com. We have different community partnerships for our universities that we work through, as well as some of our state partnerships. All of our partnerships and relationships with our clients include access, obviously, to our classes that you're attending tonight. I did want to spotlight some of our university partnerships on this slide. So we do similar classes in a learning environment for our local alumni that we support all across the country as well, too. I do want to pass along my contact information. So if you want to get connected with me after class, feel free to reach out to me. Love to be able to help you in any way possible. And I do love what our socials say about us, whether that's reviews on Google, some of the chatter that we see in some of the Reddit communities, or just people that are sharing their overall experience with us. We don't take our role in your journey towards homeownership lightly. We want to be, that support mechanism for you. And as ambassador of first-time buyer programs in our markets, we want to be here to serve you. So I appreciate you attending tonight's class. Hopefully you were able to grab one or two things to take away to help you decide about homeownership. And hopefully I get a chance to partner with you in achieving that financial goal. I want to just open it up for any questions that our class has. We got a little bit of time left before the top of the hour. If you do have any questions, you can just drop those in the chat or the Q&A, and I'm more than happy to answer those online. And then you're certainly encouraged to connect with me after tonight's class. Okay. I'm searching. I don't see any questions from the audience. So I think we're good on our side. So I just want to thank you again for spending a little bit of your Thursday evening with me. I know there's other things you can be doing tonight, but I really appreciate that you chose to spend some time with us. Have a great rest of the week. Enjoy your upcoming weekend, and I look forward to connecting with all of you soon. Have a good night.